70.9, that single number should stop every homeowner, buyer, and investor in their tracks because it just broke a record that nobody wanted to see broken. January's pending home sales index came in at 70.9, the weakest reading since the index was created back in 2010. Not during the pandemic, not during the financial crisis recovery. Right now, in 2026, demand for American homes has hit an all-time floor, and the people who should be sounding the alarm are finally starting to do exactly that. The National Association of Realtors' own chief economist has publicly labeled this a new housing crisis. 6 Fed rate cuts, 175 basis points of easing, and the market has barely flinched. What we're breaking down in this video goes well beyond the headlines. 3 things, specifically. First, the hard data on how many American homeowners have already slipped underwater, and which cities are absorbing the worst of it. Second, why the Midwest and Northeast, the markets widely considered bulletproof right now, may be building toward their own reckoning. And third, what phase 2 actually is, why it's categorically different from everything we've seen since 2022, and why the shift happening right now matters far more than most people realize. Let's start with demand, because without understanding how broken the demand picture is, none of the rest of this makes sense. The National Association of Realtors reported that existing home sales in January 2026 came in at a seasonally adjusted annual rate of 3.91 million units. That's an 8.4% drop from December, the steepest single-month decline in nearly 4 years. Compare that to early 2021 when the market was running at 6.73 million annualized sales, and you're looking at a 42% collapse in buyer activity. What separates this downturn from previous ones isn't just the depth, it's the duration. We are now 4 full years into historically suppressed demand. Even in 2008, the crash was faster and eventually self-correcting. This one just grinds lower month after month. The forward numbers are worse. That 70.9 pending sales reading isn't just a new low, it's 20% below where the index sat in January 2011, smack in the middle of the post-financial crisis rebuild. Think about what that means. Demand is weaker today than it was during the Great Recession's aftermath. Homes are sitting on the market 62 to 66 days before moving, compared to just 36 days in January of 2022. By September 2025, 70% of all active U.S. listings had gone at least 60 days without a signed contract. In Miami, that figure hit 84.6%. In Austin, 82.8%. When 9 out of 10 listings can't attract a buyer inside 2 months, you're not looking at a slow market. No, you're looking at a market that has stalled. The engine behind all of this is an affordability problem that federal policy has been unable to fix. The national median existing home price in January 2026 landed at $396,800, a record for any January on record. Home prices are now running at 5 times the median household income. The historical norm, according to NAHB data, was 3.2 times. At the height of the 2006 bubble, the ratio peaked somewhere between 5.5 and 7 times income. The fact that we're back in that range should be making more people uncomfortable than it apparently is. The monthly carrying cost for a median-priced home, including taxes and insurance, now runs between $2,559 and $2,768, depending on the data source. Redfin's analysis puts the income required to qualify for that home at $111,252 annually. The actual median household income in America sits at roughly $83,150. That is a $28,000 gap between what buyers need to earn and what they actually earn. For the typical American family, the typical American home is simply out of reach. That gap is reshaping who is and isn't in the market. First-time buyer share dropped to a record low of 21% against a historical norm of 40%. The median age for a first-time buyer just hit 38. All cash deals now represent 26% of all purchases, an all-time high. The only active buyers are those who don't need a mortgage. Everyone else has been priced out and is waiting. Now let's talk about what the Fed actually did and why it hasn't worked. Between September 2024 and today, the Federal Reserve cut the federal funds rate 6 times, bringing it down from 5.25% to 3.75%. In response, the 30-year mortgage rate moved from roughly 6.5% to 6.01%, so modest improvement that hasn't changed affordability in any meaningful way. After the first 3 cuts, rates actually climbed above 7% in early 2025. JP Morgan has since indicated it doesn't expect additional cuts through the rest of 2026. Fannie Mae's Home Purchase Sentiment Index fell to 71.6 in February, its first year-over-year decline in 2 years. 78% of consumers now say it's a bad time to buy. Builder sentiment dropped to 36, marking the 22nd straight month below the neutral 50 threshold. The Fed is not the answer here. The core problem is that prices are too high, not that rates are too high, and those are very different problems with very different solutions. Now we get to the negative equity data, which is where phase 2 really crystallizes. According to the February 2026 ICE Mortgage Monitor, 1.1 million borrowers finished 2025 underwater on their loans. That's the highest level since early 2018 and accounts for 2.1% of all active mortgages. At the start of 2025, that number was 696,000, and meaning it jumped 58% in a single year. Another 3.2 million borrowers are sitting on less than 10% equity, an extremely thin buffer. A 5 to 10% price decline in their local market pushes millions more into negative territory. Over 90% of currently underwater borrowers purchased between 2022 and 2025. Peak buyers who are now holding homes worth less than what they paid. Total homeowner equity across the country dropped by $373.8 billion, with the average owner losing $13,400 in equity over 1 year. The geographic concentration tells the story clearly. Lakeland, Florida has 10.8% of mortgages underwater. Cape Coral sits at 10.1% with values already 13% below their peak. Austin is at 9.2% underwater and 27.8% below its 2022 high. San Antonio is at 8.8%. Tampa is at 5.4%. Colorado Springs at 5.6%. But within those markets, the most vulnerable borrowers are in specific loan categories. In Cape Coral, nearly 70% of FHA loans originated in 2023 and 2024 are now underwater. In Austin, 65% of 22 Amy Vintage FHA loans are in the same position. These were buyers who put the least money down, bought near the top, and are now the most exposed. Yes, 1.1 million is nowhere near the 11.1 million underwater borrowers we saw at the 2010 peak. But in 2005 and 2006, those numbers were low as well. This is how it starts, concentrated in specific markets and specific loan types before spreading outward. The pattern is unmistakable. The price correction is already visible across the country. 1/3 of U.S. housing markets are registering year-over-year price declines. Of the 300 largest metros, 100 are posting drops. Northport, Sarasota leads the national decline at down 8.6 to 8.9%. Austin is off 5 to 6.3%. Tampa has now posted 13 consecutive months of annual declines, down 3.6 to 3.9%. Phoenix is down 2.2%, with nearly 87% of individual homes losing value. Denver is down roughly 2%, with 91% of homes declining. Florida's condo market is in a category of its own. The statewide median condo price dropped 8.1% year over year, the sharpest decline since 2010. Inventory surged 35 to 37%. Post-Surfside structural inspection requirements now affect 900,000 of the state's 1.5 million condo units, with special assessments commonly running $20,000 to $50,000 per owner. Over 1,400 condo associations have been added to Fannie Mae's financing blacklist, meaning buyers in those buildings can't get conventional loans. Inventory numbers confirm the pressure. Florida is carrying 22,157 homes for sale, 42% above 2019 levels and representing roughly 8 months of supply. Texas has 151,769 active listings, 48% above pre-pandemic norms with about 7 months of supply. Sellers are adjusting. Nationally, 34.2% of listings have taken at least one price reduction. Buyers who do engage are receiving an average 7.9% discount below list price, the largest concession since 2012. 62% of closed sales are coming in below asking. Sellers unwilling to cut prices are simply delisting. That figure rose 28% year over year. In Miami, there were 59 listings for every 100 new listings posted. Redfin reports 37.2% more active sellers than buyers, the widest gap in their data set going back to 2013. The Sunbelt correction is no longer a theory. It's documented and ongoing. But here's what's genuinely important to watch next. The markets that carry a reputation for stability right now, specifically the Northeast and Midwest, are showing early cracks that most analysts are overlooking. On the surface, the data looks healthy. Chicago led the Case-Shiller index at plus 5.7%. New York posted a 5% gain. Hartford, Connecticut is being called the hottest housing market of 2026. Inventory in these areas is still 40 to 60% below 2019 levels, which is what's holding prices up. But there's a problem building underneath. These markets are appreciating sharply while simultaneously losing population. New York shed 137,000 net domestic migrants in 2025. New Jersey and Massachusetts continue to post net outflows. Illinois lost 40,000 residents. Prices are climbing in markets that are physically shrinking. That's not a sustainable dynamic. It is a crash imminent in these places. No, supply is too constrained for a near-term collapse. But stretching out 12 to 18 months, buying into a significantly overvalued population declining market carries real risk. Austin is 27.8% below its 2022 peak. Hartford is 21.2% above its 2022 peak. Those trajectories don't stay separate forever. So what exactly does Phase 2 mean? Phase 1 was the freeze. From roughly 2023 through most of 2025, buyers stopped buying and sellers stopped selling. Transaction volume evaporated, but prices held because supply did too. Sellers with 3% mortgage rates had no urgency. It was a standoff, painful for the industry, but structurally stable. Phase 2 breaks that stability. Phase 2 is a forced selling market, and several pressures are converging to make it happen. The lock-in effect is fading. The share of mortgages with rates above 6% now exceeds the share locked below 3%. Owners who purchased between 2022 and 2025 are carrying housing costs that consume 35 to 40% of their income. When a divorce, a job loss, a medical crisis, or a relocation hits those households, they can't hold on. They sell. Negative equity is beginning to cascade, with 1.1 million already underwater and 3.2 million more dangerously close. Every distressed sale that closes at a loss pulls nearby comps down and pushes more owners across the line. That is a self-reinforcing cycle. It followed this exact same path in 2007 and 2008. A wall of commercial debt is due this year. Over $930 billion in commercial real estate loans mature in 2026. 60% of the most distressed apartment debt comes due in the second half of the year. When those loans can't be refinanced or extended, forced asset liquidations follow. and those feed directly into housing supply. The Sunbelt migration engine has stalled completely. Florida attracted 310,000 net domestic movers in 2022. In 2025, that number was 22,000. That is a 93% collapse in inbound migration in a single state. Alabama now records higher net domestic migration than Florida. Texas fell 70%, from 222,000 to 67,000. At the same time, net international migration to the U.S. dropped 54%, according to Census Bureau data, and is projected to fall further. And these markets built enormous housing supply during the boom, priced it to reflect a flood of arriving buyers, and now that flood has essentially stopped. Foreclosure activity is accelerating. Filings rose 14% nationally in 2025. FHA delinquency hit 11.52%, the highest level since 2021, with FHA loans now accounting for 52% of all seriously delinquent mortgages and 80% of the increase in foreclosures. The distress is concentrated at the entry level. First-time buyers, lowest down payments, most stretched budgets. The Treasury Secretary has publicly stated that the housing market is in a recession. Phase 2 is not a prediction. It is already underway. The slow drip of distressed listings is becoming a steady stream of foreclosures, short sales, and aggressive price reductions. Record low pending sales, a 58% increase in underwater borrowers in 1 year, FHA delinquency near a 5-year high, foreclosure filings up 50 to 88% in the hardest hit metros. The data isn't ambiguous. If you're in a supply-constrained market like Hartford, Rochester, or Chicago, your local picture is genuinely different. Don't project Sunbelt dynamics onto markets with fundamentally different supply conditions. But if you're in Florida, Texas, Arizona, or Colorado, the numbers demand a clear-eyed response. Sellers who need to sell price ahead of the market now. Every month of delay has cost Austin sellers another fraction of 27.8%. Waiting for a rebound that isn't coming is an expensive strategy. Buyers, slow down, study your specific market, and let the data drive the decision. The next 12 months will hand serious advantages to buyers who do their homework and serious losses to those who don't. Phase 2 has started. Here at US Realty Pulse, we'll be tracking every data point as this unfolds. If you're making real estate decisions in the next year and you're not watching this space closely, you're operating blind. Subscribe, turn on notifications, and drop a comment below telling us which market you're watching. We'll see you in the next one.